Hey everybody, Economic Ninja here. We're going to talk about auto loans. We're going to talk about banks and financial institutions that are holding these loans and how dire this is getting. I have two stories to share with you today. First is out of the New York Post, and it is entitled Car Payment Defaults Hit 29-Year High as Borrowing Costs Surge. So now we have got two sides of this coin right now. You've got the consumer that is unable to make these car payments, so they are not paying on the payments. That's bad for the economy. That's good for us that are wanting car prices to come down. There's going to be a wave of repos, all that stuff. This other side is the banks that are holding these notes, and they are failing. Okay, so this is going to lead to an even bigger banking crisis. Okay, so it says here, inflation squeezed Americans are defaulting on their loans at levels not seen in nearly 3 decades as record high borrowing costs threaten to price many Americans out of the market. It says for those with the best credit scores of at least 750, average interest rates are about 5.07% for a new car and 7.9% for a used one, according to Bankrate. Buyers with credit scores less than 640, meanwhile, are looking at distressing interest rates of about 14% and 21% for new and used cars, respectively. Now, remember, every time we see more people decide not to make a payment, whether it be a credit card, anything, any kind of debt, they now shot their credit. They have way less chance taking advantage of this next housing crisis that's coming, or being able to buy at a rate even that's good in today's standards, which is 5 or 6%. Okay, so then they're being forced to pay 14%, 21%. And if they're not good with their money, which honestly, most Americans are not good with their money. When you see the average savings rate of the amount that the average American holds is $400 or $500 in their bank account, these are not savvy investors. These are not intelligent people when it comes to fiscal responsibility. All right. So you can see how this is progressing down a slippery slope. Now, it says inflation squeezed Americans are defaulting on their auto loans at levels not seen in nearly 3 decades as record high borrowing costs threaten to price many Americans out of the market. It says September's delinquency rate is the highest since 1994. There was a good sized recession. And actually, very important to note about that recession of 94 is that in California, to give an example, it was nationwide. Sorry. The Fed decided to put, I believe it was 2 points on new construction loans around the country to slow the amount of building that was going on. Many people don't remember that. And what that did is that put a lot of home builders out of business. And you have to see these cycles and how they go through. They're always the same. They look and smell really, like, oh, it's a little different. They're all the same, okay? It says Fitch reported this, right? September delinquency rate, highest since 1994, which can be attributed to the Federal Reserve's decision to hike interest rates, blah, blah, blah. We already know that story, right? Between 5.25% and 5.5% for the Fed funds rate. Fed officials unanimously decided to hold interest rates steady last month, the second pause in 6 policy meetings central bankers have had so far this year, though they've signaled that another hike before the year's end remains on the table. It absolutely does. As a matter of fact, I believe you're going to see 2 hikes. It says, should the Fed keep rates higher for longer in its quest to bring stubbornly high inflation back down to 2%, defaults on auto payments are likely to persist. Okay, so it's very, very bad right now. To make matters worse, Americans are also defaulting on their credit card loans, with delinquencies now reaching 3.6% so far this year, according to Equifax. And looming student loan payments surely will not help the situation. All right, so now let's go into story number 2. And this is very important that people understand how big of a deal this is, because this is going to take down the banks. Between commercial mortgage-backed securities and auto loans, you are going to see so many banks cratering. And actually, there are a lot of private mortgage lenders out there, meaning that banks taking financial houses, taking on this debt, that are also going to be strapped. So any way you look at it, the banks are going to be failing in mass in 2024. Okay. Type 1 if you agree with that, type 2 if you don't. I'm just curious. All right, now check this out. This is out of automarketing.com. How auto finance companies are likely to handle further deterioration. Isn't that a nice way of putting it? They're going to handle further deterioration. They're not going to handle it well. I'm going to tell you that much right now. It says, while also looking closer at the subprime segment as well as credit unions, S&P Global rankings. Hey, wait, can we do me a favor? Massive favor. What, 5 minutes into this video, 5.5 minutes? Can everyone just hit the thumbs up and just start typing random crap in the live chat right now? Let's freak the algo up so it wakes up the video, okay? I really appreciate it. Just type whatever. Just keep it clean. All right. So right here, subprime. While also looking closer at the subprime segment as well as credit unions, S&P Global Ratings acknowledged 5 primary ingredients will likely create further deterioration of outstanding auto finance portfolios. However, firm experts see banks, captives, and other providers being able to weather the challenges. I do not agree with that, okay? But we're going to go into their points because I believe they make some good points. But I do not believe many of these banks are going to be able to weather this. I love it how people are typing random crap in there. Type random crap. Okay, random crap. All right, here we go. First, the elements S&P Global Ratings noted as being the catalyst of portfolio deterioration include, and these are the points, high interest rates, high outstanding balances on these cars. I mean, we're looking at, the other day, I was looking at a, not a Tahoe, but what's the equivalent? A Yukon, a short Yukon, loaded up, right? $98,000. We're about to crest $100,000 for an SUV. Okay, this is madness. All right. And when you also, I have to say, most people aren't going in paying cash for these cars. You got to think about this. So high interest rates are going to affect the banks. The high outstanding balances on these cars, falling used vehicle prices, consumers declining in savings accounts. Their savings amount are declining every month. They are running out of the government stimulus. They're running out of their only savings because inflation's hitting their pocketbooks in every aspect of their lives, right? And then the fifth reason is likely economic slowdown. Type 3 if you think there's an economic slowdown already occurring. Type 4 if you think there's never going to be a slowdown. Just like Janet Yellen says, there's never going to be another banking crisis in our lifetime like 2008. Well, fast forward a couple years, Janet, and you were wrong. They said, we expect that the entities that will be affected the most are the banks that are most active in auto lending. So think about credit unions. There's a lot of credit unions where all they do is a majority of their bank's loan portfolio is in credit auto loans. So you want to look at that, right? Captive auto finance companies and non-bank subprime auto lenders. I completely agree with all those. We also think elevated funding costs and tighter funding conditions will eat into profitability and likely limit lenders' appetites for new originations. We've already seen that in all kinds of banks. Bank of Montreal is the latest big bank to completely walk away from auto lending. It's getting to be a big deal, all right? At the same time, we believe these pressures will generally be managed for most rated institutions, and we don't expect negative ratings actions to be widespread, firm experts continued. S&P Global Rankings elaborated more about the subprime market, reiterating that there are only 2 providers that analysts officially rate. Tougher financial conditions could also weigh on subprime lenders' origination volume and profitability. Access to funding to support new originations is crucial to auto finance company operations. Now, just so you know, a little background on that. An auto finance company doesn't just have a bank with a bunch of money in it. They go and source paper. They go out, or not paper, sorry, they go out and source the funds. So they go out and get these blocks of money and they go, hey, look, this is the type of paper we're cutting right now. This is the credit level of the average borrower for our car loans. And these are the rates we've been given. This, we want to borrow another, let's say $10 million, get a $10 million tranche of funds in to be able to loan out more money. And so it costs them a certain amount to get those blocks of money, all right? They go on to say that the unfavorable The unfavorable debt market conditions we see now, coupled with macroeconomic headwinds, have worsened financial financing conditions for speculative grade companies. Looking to refinance or issue debt, they continued. As a result, we expect that these lenders will rely on secured markets to both fund their portfolio growth and address upcoming corporate debt maturities. So very, very important that people realize how much this debt is costing these companies right now. In 2022, they go on to say credit unions, which had considerable amounts of cash to deploy, grew their market share significantly in auto lending. That increased competition for loans, and banks and captive lenders saw their market shares in origination shrink. When these originations shrink, it gets bad. And so, long story short, we're going to see these continued headwinds hit the market even more, even in greater numbers when it comes to auto lenders. And I think that's what people need to be watching out for. Hey, I hope you have a great day. Thank you so much for watching. The Economic Ninja is out.